Hi, this is Randy Finney with Bright Side of the Chart, and today is Friday, April 26, 2024. It's 11:34 a.m. Eastern Time. I'm starting the video, so we're a couple hours into the trading day, and figured it'd be a good time to get one out, especially as we're about to head into the weekend. And so what I'm going to do in this one is cover the indexes, mainly the big one, of course, QQQ Nasdaq 100, and go over the FKA, formerly known as Mag 7 stocks. We're going to look at the technicals, give you the levels to watch, my thoughts on each, what we need to see to firm up both the bearish and bullish case. Obviously, I still lean towards the bearish case. Nothing's changed. We're still way off the highs right here. We're still below the trading range. And so other than a little supercharge on the animal spirits for the bulls on the Microsoft and Alphabet earnings, and I'll talk on those and we'll go for those stocks. Nothing's changed technically. We're still below the breakdown level. So what I'm going to do is, before I get to this, we're going to go through QQQ, the NASDAQ 100, and then those top 7 or so stocks. Time permitting, I was going to, and I might have to do it in another video, go over the chip equipment makers. You know, the semis are a subsector of the tech sector, one of the most important, with the most important stock out there right now, NVIDIA being a semi as well. And then you have the chip equipment makers. So the semis, I've always said, are pretty much the canary in the coal mine for the tech sector. When they start wobbling and showing cracks, that's typically early signs, because chip demand's down. Microsoft, Alphabet, all the big tech automakers are ordering less chips, and then you get a turn in the sector, and then ultimately the tech sector follows. So if the semis are the canary in the coal mine for the tech sector, which is of course the canary in the coal mine, or is the overall market due to its heavy weighting, then the chip equipment makers are the canary in the coal mine for the chip stocks, because that's what happens. They make the equipment that makes the chips, so when their orders start getting cut back, it's the semiconductor sector showing you that you see clouds on the horizon. All right, so that might be a different video. Depends how long this one goes. I'm going to do brief updates, starting out with GDX, because I had I want to call it a chart request, but it wasn't. It was from our resident troll, Becky, making a snide comment about, got clobbered on the GDX trade. And so, although it wasn't a chart request or any update, it was just our usual, don't mention any of the trades that pan out, just criticize any of those that fail. And this one hasn't failed. I'm going to talk on that real quick. I'll go over what I mean by that. I've always said this over the years. There's it might seem like a subtle difference, but it's a huge difference in trading or investing on being early or wrong. Early, for example, we'll use QQQ. I've been talking about the pre-Fed short just because that was the high, and so far it's worked out good. But QQQ is really a swing trade that's been going on now with about 3 primary entries. But the thing is, guys, and this, all the trades are not binary. Very few on the site, especially this one, because you're trying to call a major turn in the market. By binary, it means 1 entry point, 1 exit point. 1 entry, no additions from there, and 1 sole price target. That's not the case here. So in this one, if you recall, I have to go to the 60-minute chart. This is a 60-minute chart. Back here, it was based on this one. We had a break of this yellow trend line. That was the primary uptrend I was looking at. That was our first short entry that we've had after coming long into the year, after actually coming in short into the year, and then right at the right here hitting targets. I'm sorry, we came short in the year here. We were short back here, hit that second target, bounced, we went long. But these were all different trades, all closed out, targets hit, and then reverse and long trade in the beginning of the year when T2 was hit here on the trend line. But this was, I believe, if I remember right, entry 1 on the minor trend line break, entry 2 here, and entry 3 on these back tests, or whatever you call it. So a scale in, all in this range with an average cost somewhere in here, in the most recent, the most recent being a break of 433, but then before that up here. So every single entry point is profitable, or this one at worst break even right now. So I just wanted to talk about that. And I'm sorry if it sounded like I went off on a tangent. So this is the thing about being what I say early and wrong. So if you believe in a trade that we'll say QQQ is going down here or much lower, and that's your price target, and you short it here, let's say, and based on your risk reward ratio calculated with your price target, you have a stop up somewhere up here, and you go up there and you hit that stop. Doesn't matter if it's, one day and then turn around next day, you may short it, get back in, but you were stopped out, you were wrong, you lost money, you booked a loss. And then even if you got back in, then the next one's profitable. You might have said, okay, they ran my stop and it still looks good, I'll go back in. I do that quite a bit. And that's wrong. And then this one might be right, but that trade was wrong. This one in this case is the same trade. And this is the difference of early and wrong. It can take months. I might have thought it would go down quicker. And as long as ultimately we head on down here, you can call it successful or not. And we sat tight on T1, bounced and reversed it off T2, added that. So the whole thing is more profitable than the drop or the average entry price. Again, if you're swing trading that way, what I call active swing trading. When the odds are good for a bounce, I'm going to game it. So there we are. Coming back to, but not all the way to 433 yet. Still providing an objective short entry, as I said, anywhere up to, but not above there. Me personally, give it a little bit of room. I could almost smell a little stop pop there. Seems like a very likely scenario. And if it's anything more than that, and we're probably not going to know that until next week. I'm going to tell you that right now. It's Friday, a couple hours left in the day. But let me go over the charts, and again, I'll give you the levels to watch, and then you decide how to factor that in and manage your positions. So there's QQQ, the board I got out, the chart I got out to you today. I really wanted to see and preferred. Remember, we were in pre-market, we were there, but I said it doesn't really count to me. QQQ, when I'm looking at things like divergences and things like that, I like to see them on the regular session trades, and that's now what we have. We took out, we had to make an equal or marginal new high, which we've now done. Here, let me show it. And so that gives me that divergence here that I was looking for on the 60-minute chart. One of my favorite, go-to things. So when you have, negative divergence and a downtrend and you're at resistance, this is my preferred swing trading time frame. Now, I always say, and this is a little kind of nuance I've created years ago, to me there's two types of divergence. There's potential. Right now you have prices making higher highs and the indicator making equal or lower highs. That's all it has to do. But to confirm it, you have to make a bearish PPO crossover with that putting in an equal or lower peak, assuming prices are higher. And so that's what we need to do. Is we need to reverse soon to get that. And that's not the be-all, end-all. It's just something that helps strengthen the case. So let's take a look at the market leaders. But before we do that, let me go back to what I was talking about on the chart I posted. So my comment of early and wrong, what I replied to that comment, really not a chart request from Becky. And I'm going to put a level in here, guys. I just see it as I'm pulling this chart. What we did is we had a GDX short way back here with these price targets. So go away. These price targets here. It went up a little higher, and I said I had a suggested stop that I said I was pulling because based on the charts, we had still big divergence growing, and the case was made with gold and everything else breaking down. I'll try to get it in a second. So we did. We put in that divergent high, and that was, still part of this trade. It didn't violate an RR based on these, or a stop, or at least an extended stop based on these targets. We went on down, and so the last update I gave, and you can see I posted these charts in that comment section. The last chart I gave, here, I can pull it up for you. It's right here, April 19th. And so I had the divergent high, S1, which is first support, hit. S2 was right here. It's hard to see because it's under the candle. It says S2 trend line, which was hit. That's this trend line, the primary trend line. And then we took out the trend line. We hit my S3. And the reason I list these as S3 because they're too shallow. They're just the initial support levels. And the way it works is support until unless broken. So we hit S3. Then we bounced. I did an update. We had a little wedge pattern going there, a little bearish rising wedge or a micro trend line underneath. And so I had it going down here with a reaction. That's what an arrow break will show. Another reaction on S3, and then break S3, and then we go down. So in my updated chart, or the comment I replied here, I can pull the updated chart. It was in pre-market, and I said, okay, so basically, no, this trade's just like QQQ that went sideways for the last almost 3 months. This thing's gone sideways here, and S1, remember in trading, support once broken then becomes resistance. That's what we bounce back. So that was that. Since that last update I gave you, I guess I hand drew in that trend line right there before, but that was it right there. We had that little wedge. And again, that was the 19th. We broke down, hit S3 again, another reaction right back to S1, which is really now R1 or resistance. And so this is the most likely scenario. So let me pull it up now, the live chart. Let's get rid of these. And that's it. So we're right there. We're still having a reaction, if you will, because we've hit it and we've consolidated on it. And that's that. And based on the charts of gold's pretty much does the same thing. I always say this. If you're going to, I like futures. If I'm trading gold, I'll trade GC. Or sometimes in certain accounts, I don't use futures. I'll use GLD. But I'll typically go with GDX. GDX, it's just like our TLT long right now. Instead of IEF, the 10-year treasury, or I'm long ZB, the 10-year treasury, 30-year bond futures. Or I said you can buy TLT. It's the same thing as an ETF. Same thing holds true with gold and GDX. Gold mining stocks are going to follow gold up or down almost in lockstep. They're just going to go up in a multiplier. It's not a set formula, but it's usually twice or more in percentage terms. And so why burn up capital if you're either going to be right or wrong in the trade, just like with bonds? The 10-year is going to rally and the 30-year is usually going to rally more, or vice versa if they drop. So that's gold. Breakdown back test. And it's been struggling here on this. It was struggling on that 222 resistance, and now we're in this little trading range here. We need to break this recent low. Oh, and we've just broken this secondary, or actually this primary trend line right here, and we've been back testing it from below. So PPO's down in bearish territory. So I still think gold, the risk reward is to the downside, and still looking for more downside there. And so there's your update on the metals and miners. And the other one I wanted to update, just quick, I did it yesterday. Wheat should be coming up on. It's getting close to that T1 now. Let's see, I haven't hit it yet. But nothing but green sticks since the breakout. Test of R1, pull back test the trend line, and then boom. It's been pretty good volume too on wheat. So that one still looks good up to any or all of these targets. And I may add additional longer term targets depending on how the charts develop. So that's your update on those two. Natural gas is still grinding around doing its thing, towards long-term support. So now let's go to, before I get into the markets, talk about our hedge and how that works. TLT, it's given back a little of gains. It was up almost 1% earlier, about 0.8%. And remember, TLT is what my indirect hedge. I told you I'm not a big fan of direct hedges. They're costly. It means if you're short the NASDAQ 100, you buy you buy calls on it. Some people will go and buy shares on it. To me, that makes no sense. Your broker's the only one making money. It's a washout trade. If you have that little confidence in it, throw it away is what I say, or just set a tight stop and let it see if it runs and plays out, or you get taken out. So me, I like these indirect hedges because if I'm right on my read, then it should offset any losses on one or the other trade. The gains on one should offset losses. And in a good scenario or a likely scenario, they both can profit. And that's the case. Today they're not both profiting, but TLT, I always say I use at least a 2-time beta adjusted position size. And so it's up 6.62. So that's a 1.2 or better. It was a little higher earlier gain. So it's offsetting any givebacks. But we also, I told you yesterday that before we went into the day, yesterday's video, we had Google, Alphabet, and Microsoft on deck. So no reason to go crazy short. It wasn't an all-in moment. It was all in for me the other day, but then I covered and went long yesterday, like I told you, and then pulled back, went short again. So today I've added. This is where I think now it's objective to be, aggressively short again, but not above that 433 QQQ level. Again, we'll address that, and it'll probably be Monday. No matter what happens today, they can go into 433 a little bit. There's not enough time left in the trading day to get that far into it, based on where QQQ already is. So I'll assess that next week if we happen to close up on there and don't reverse today later in the day. So there's TLT, still, looking good as a hedge. And then that also plays into, remember, IEF is a 10-year, and you can take IEF. It's just like trading gold instead of GDX. It's gonna move in the same direction, just less in percentage terms, because these are shorter duration bonds. You have downtrend line, all that. So we could break out here, but remember, we've been down in this orange zone for a while. And when I talked about it before we even got into there, that the market would take note, and it did. We've had the biggest correction in so far, well, of course, so far all year, and pretty much almost maybe even more than the one last year, any correction in QQQ, and this is the market taking note. Now, I said this is also not simply an up or down thing, bullish up, bearish down. There's also a the X and the Y axis, where it's a time thing as well. The longer bonds stay down, that means rates are staying elevated, the bigger impact it's going to have. A lot of bulls have fit their, use confirmation bias to fit their thing and saying, oh, higher rates don't matter. This economy, you can see it's comfortable with this. No, these rates will matter. We know there's a huge amount of corporate and private debt coming due this year and next year. Debt maturity wall, they call it. And so again, the longer rates remain elevated. So my point is, we can see an uptick on bonds, which would be an abatement in yields. But as long as it's not way back up here, as long as we're in here, it's really not going to have much of an impact on the economy. It may have some psychological impact on the market, or maybe not. But like I said, I feel comfortable for now, keeping that hedge on with the TLT against the index shorts, which I may pull off next week, depending on what happens in the stock market. So you still have the positive divergence there on CB and IEF and TLT. Okay, so that's it. I don't want to go on too many other trade ideas. I just touched on kind of the core ones that I've been talking about in trading. Let's go back to QQQ, and then let's just walk through the Mag 7, or formerly known as Mag 7, now Mag 3 or 4, I think. What do we have? And then we'll wrap this up. So there it is. There's that setup. Like I said, we're still way off the highs. There seems to be, I'd never ever turned CNBC on except during big earnings or FOMC meetings to just see what the results are. And then you're invariably going to hear the talking heads. And my God, did they march out the bull brigade last night. Usually they'll put somebody with a contrary opinion. No, everyone was just foaming the mouth bullish. And one guy even went so far as to say that it doesn't matter. Yeah, he acknowledged the S&P earnings. I think they were looking at 3% growth in all of the market in the S&P 500, but yet like 40% on a handful of things. Because that's good, because that's what everyone's buying. They're buying the indexes because of those stocks, and that's going to keep them going up. If you know anything about investing, technical analysis, you know that is a very bad sign for the market when fewer and fewer stocks, declining or negative market breadth, is not a good thing. And it will eventually crater no matter how good the earnings are. You cannot have, back in the 70s, it was a Nifty 50. Then it was the FANG, F-A-N-G, and then FAMG, and now Mag 7, and now that's contracting. So, some are calling it the Mag 4 and Mag 5, whatever. All right, let's get into those stocks. You know all about QQQ, where I think we're going there. Microsoft, biggest of the lot. All right, so what's happened to Microsoft? Just a quick recap. Yesterday we broke down. We took out my key yellow level, but I said take it with a huge grain of salt because they're reporting. You don't, you have to just, again, take it with a grain of salt. It really doesn't matter as much unless we, after earnings, then you're closed solidly below that level. Right now, they popped it up, but all they did is basically that was, we closed almost right on the 397. So basically, we remain within this trading range. Nothing, and let me repeat this, nothing technically has changed. If anything, what I see here is, I'll turn off all the lines and you can see this. Microsoft has taken out the 50-day moving average. That's this yellow line, bullish when above it. Bearish when you take it out. A lot of algos and humans will buy the 50. Support when you're above it, and then resistance when you're below it. took it back there. And remember, we've had a lot of sideways trading, but overall, it's near term. It is a near term sell signal, if you will, by that one metric. You can see we're just back testing it today. That's all we're doing. I can't spin that as bearish, but it's a rally back into resistance, but more so a rally back into this trading range, or I should say we never really left it. We intraday pierced, but again, you know me, if it's a daily chart you're analyzing on, all that matters is how you close the day. And I say if you have to squint to see if you broke down or not, give it the benefit of the doubt. So there it is. And earnings, again, like I said, the big thing was earnings, so you dismiss it. So nothing really has changed there. We had this period where it broke out here and had a sub trading range at the highs, but then we went on to break we broke the trend lines here, the primary and the benefit of the doubt. Again, I can't make too much of this right now. It's up today, so can't knock it as bearish. Nothing's changed in weeks or months even. I've said we have to break 397, and when we do, that'll open the door for these targets, and we haven't broken it yet. And nor have we gone back above the top of the purple trading range, or even that, that would be bullish, step number one, which would take away. Remember, I never got much of a check. I had a little check mark here back from Microsoft, but this was the one I was really looking for, 397. So pop it above the top of the range, which is about 417.50. Yeah, that gives a check mark for the bulls and takes a check mark away from the bears, or gives an X mark. And of course, a breakout above the recent highs of 430, especially now that, by next week, or if it happens in the next few weeks, the market will have plenty of time to have digested the earnings. And as I always say, the initial reaction is quite often faded. Don't read too much into it. So again, I'm spending a lot of time on a stock that's really a non-event, in my opinion. That's it, technically. Apple, as you know, as I've been saying, the most bullish of the lot when I'm referring to the Mag 7, with positive divergence on the daily chart here. You are below that negative 1.18 level on the PPO signal line. And again, that delineates bullish and bearish trends, so it has a higher rate of failing. We've had 2 false breakouts already above the downtrend line. Will this one stick? Third time's a charm? We'll see. All I can tell you is near term, this was bullish, that it took out that recent low, that same low back here we rallied off of, and we're above it now, but we're also at resistance there. And I'm going to do this. I'm going to step to 2 time frames on every stock. I forgot to do it on Microsoft. We're going to look at the 60. So I'm going to give you levels. 60-minute chart, uptrend line right here. Remember, you have pretty strong divergence on Apple. If I decide to start taking any additional hedges, and it won't be until next week, most likely, maybe before the close, this would be one of them. Instead of TLT, I mean, here's an indirect hedge, because you can have one stock, going up and QQQ going down. Again, it's the best looking technical posture. As of now, I'm not buying Apple. It's at resistance, and so far we've seen a series of failed breakouts, which is indicative more of bear market action. Can't call it a bear market, but it's certainly not a bull market, or at least a bull trend. At best, it's a large sideways trading range for the last, going back really here, we entered that range back in May, like April, almost the end of April. So it's a 1-year trading range, and we're at the very bottom of it. So Apple is in a precarious technical posture. One bad day could take it down below there, and if it already broke and dipped back up once, another break of the lows would almost certainly do the trick, in my opinion. I think the dip buyers would give up at that point if this low gets taken out. That's my take. And no, if you're bullish, I know there's some on the board that are, long Apple with a stop below those lows is one of the, if you want one of the leading tech companies, there's your potential levels. Microsoft, I need to just loop back to, because I wanted to cover the 60s on each one. And remember, this is the bigger trading range I had on the daily right here. You can see it right here. I'm trying to square tool it, and I missed that box tool. There it is. And so you're smack in the middle of the range, and you're at resistance. You hit resistance today. These are all minor resistance levels. So again, just a lot of noise, but I wanted to make sure I covered all time frames. Here's Alphabet. Let's start on the daily. Same divergence has been building for months now, almost a year. You can see it very clear on the weekly chart. Let me park the PPO histogram just to make more space for the PPO. and RSI right here. Someone mentioned the other day, yeah, sometimes you have a slightly higher high, and for all intents and purposes, you know, when you have much higher highs in prices, that's still divergence. It's technically you've moved above the other high, but I've seen a lot of stocks, you know, as long as you have it at least on one indicator on the weekly, that's usually good enough to do the trick. And there's no sell signals on Alphabet at all. Monthly chart, big divergent high, just like you had heading into the 2007 highs. And there's a massive gap down below. What I can promise you guys, I can't promise you where the market's going, but I can promise you if the majority of these Mag 7, especially if we get the sell signals on those last holdouts, remember, every sector, all the top 5 sectors, the ones that matter, I got sell signals on. Weekly indicators rolled over. QQQ broke 433. NVIDIA broke 430. I'm going to get to that in a second. And I don't care. I know Google implemented a cash dividend. It's got, opens up other funds to buy it. It's bullish, mega earnings. But, it's if the rest of the lot goes down, I've seen this time after time. In every bull trend, there's always fewer and fewer stocks doing the heavy lifting, the big popular names. And ultimately, no matter how good the earnings are at the time, the most recent quarter or the forecasted earnings, if the others roll over, and we've seen quite a few, we need a little bit more, it'll get dragged down. It's like throwing a chain and watch on TV on the movies and they throw someone off the boat, chain a cinder block to their ankle. That's what it's like. And why is it that way? It's simple mathematics, because if the others start breaking down, that's because money is flowing out of those stocks. They get sold. The indexes get sold. The indexes have to sell what they have proportionally, and therefore Alphabet gets sold. So big old gap. And if anything, based on where it is now, paired trade, short Alphabet, long Apple, I'm not doing either. I'm just sticking with the indexes now. There's too much. Earnings are almost out of the way. We have Amazon next week, I believe, and then Apple the following week, and then we're clear from earnings. But let me just show you. So on the 60, there's not much. When you gap up like that, there's a big old gap. Still even divergence. If we close the day down, this PPO will move down. You have the potential, if we gap down on Monday somehow, for an island top reversal. But again, I can't spin that as anything but bullish right now when the stock's at an all-time high. But again, I'm doing this video to show you collectively how the stocks that matter the most. Okay, big one here, because I'm sure there's some questions about NVIDIA. Remember, I had 2 levels. 840 was a big one, and we broke it. Number one, today is not over. We're at 863. It sounds like a lot. 23 points on an 840-point security is a fraction of 1%. All right, so I should say a couple percentage points, about 2%. But we're also at that trend line I showed you the other day. We had just above 840. You have a downtrend line coming off the highs. And so if they step in here, which I suspect they will, we're going to close on or around that 840 level. All we have to do is reverse 2% in the day, and that's not a lot for NVIDIA. There's the downtrend line. You can see it very clearly on the 60-minute chart as I zoom in. It starts off these recent highs, comes in on that high around the 15th of the month, and right there, right now. So, you had here on the 60, I had it as a support zone. That's where we're at right now. Sorry, I had to pause the video for a phone call. So let's see what happens there. That's a pretty big level. And again, let's see how we close the day on this one. As I always like to say, if you have to squint to see a breakout, then it's too close. This right now, it's pretty green above there, but right on the trend line. Again, let's see how we close the day. Let's see how it follows through next week. I will say, if you take this trend line, if you park even here today, that in itself is bullish, coming back above 840. Take out the trend line. This market is full of whipsaws. If you gave me unlimited money, let's say you gave me the Fed's checkbook and I could open a brokerage account and I could then run these stocks up, that's where I would run NVIDIA if I had enough money to move the market, move the stock, blow out some shorts, turn around on that short covering pop above 840, then short it myself and go back down. That's how the the algos, these the big trading firms, that's how they think, and they collectively have enough money. Now this may stick. Right now, it is bullish, but the day is not over. So these are the things to look for. And then more bullish if they can take out the trend line. Next stop is 908, resistance in the middle of the zone. Then the top of the zone, 970. If you get anywhere up there, just like QQQ, they're probably going to punch through the top. Remember, this is not a binary thing either. It's incremental. Every tick higher on NVIDIA, every tick higher on QQQ above 433 is incrementally bullish, and then we'll increase the odds of breakout new high. Until then, especially with QQQ being below support, tech sector, I'll try to do the sector ETFs in another update, but I've covered them recently. They're all well below the breakdown levels. I'm talking about the top 5 sectors. The only sectors that are doing well are the ones that shouldn't be for the market, that the market doesn't want to see too well. Energy, because of high energy prices, the sticky inflation. Utilities have been moving up because they're defensive issues. So you're seeing, like I said, any sectors that have been doing well are the ones that overall for the stock market shouldn't be doing well. If the economy is strong and not heading into a recession, then you wouldn't see a lot of buying into defensive issue stocks. And again, every uptick in energy keeps that sticky inflation thing going, and it keeps the chance of rate cuts lower. Alrighty, Amazon next week. Amazon, no change. Yesterday it hit, as I pointed out, I believe that my key support has been for months now. 165.74, kissed it, bounced back to the next resistance I had on there, 179.29. So ping-ponging between resistance and this trading range here. You had this range, then just like Microsoft, you had a brief break above it and a fall back into the range. Typically when you have, that's a failed breakout. A lot happened on Amazon. Again, they're going to report that could change the charts, but you know my thoughts. And again, I have to reiterate this, I say it often, it's not the initial reaction. You got to wait within a few days. By the next week or so, you'll know if the breakout's on Microsoft or not. Microsoft didn't break out. Microsoft did nothing. If Alphabet, if that's going to stick or not, you should know. If they start to fade that gap next week, if the entire gap is faded, that is a get out of Dodge moment. There was a big gap, a lot of volume today on Alphabet, and it would be quite bearish. And of course, if it holds, great. That's good for the market. So this one went down, a little flagging action, hit that. But again, it's all pre-earnings noise because they're going to report. So nothing has changed. I'm watching 165.74. If it can take out, roughly about 180. But again, anything, I wouldn't go long or short. This particular one, it's a crapshoot before earnings. But I do still maintain these targets down here, the purple lines, the 200-day moving averages, and that level to go. We just need some of these other stocks to buckle. We need QQQ, of course, to take out the recent T2 support it hit. All right, Amazon 60, right at resistance. So this is kind of, when I go down to the 60s, this is, what to look for, what may happen today. So Amazon rallied right back. Remember, I had it at about 180 on that daily chart. And you can see, why is that level there? A lot of reactions. Boom, 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 breakout. Come in and back test. They bought the back test. Boom, then the breakout failed. Tried to get back above 180. Support once broken becomes resistance. Boom, rejected. Right back to there. And this is what I think will happen. If that happens, then it's hard to spin that as anything but bullish. But again, take it with a grain of salt because they're going to report next week. Meta, it's only day 2 after earnings, but this one took out both my yellow levels and remains above them. So technically it is, and it's in that gap. And so 454.50-ish support once broken becomes resistance. So any pushback to there would likely see the seller step in. And I still maintain this one coming down to the 200 days and or the bottom of my target zone here, about call it about 400. I'm still my initial target on Meta, and so there's a check mark there for the bear case. This is the other share of Alphabet, so really nothing that's GOG. Broadcom I usually don't cover, but it's actually bigger than Tesla now. Remember, Tesla is no longer a magnificent anything. And by market cap, Broadcom is 588 billion versus Tesla at 516. So we should look at Broadcom like everything. Got to go back this far. It's in a trading range. And Alphabet's broken out to new highs. Nothing else that I can think of offhand has, and quite a few have broken down. So that's it. Now I will give it points because there was in that trading range, which again is right here, goes back to January. As I often do, I can look at a trading range. I don't force it, but I always see, almost always see a right around the midpoint. Sometimes it's a hair higher, hair lower, a support and resistance level that gives you these sub ranges. So when you're in the bottom of the range, it's resistance. You break above it and you usually go to the top of the range once you break out above the midpoint. Likewise, once you go to the downside, you break above there and your next stop is the bottom of the range. So I will give it points today because it, did it again, broke the bottom of the range, went there, and it's right here. How we close today will be very telling. If it's, that's going to increase the odds we go up there if we remain above that level. It's not a sure thing. Probably, yep, I can draw a downtrend off the highs right there. I've got 3 nice distinct reaction points, the high right there and these 2. And so there's some resistance for Broadcom. Bullish if it can take it out, and then even more bullish if it can pop above the top of the range. And then there's Tesla. Like I said, Tesla is the other one that I would be long if I, besides Apple, the FKA Mag 7 stocks. Again, all the others have big negative divergence, and they're at or near their highs or in trading ranges, where these two, Apple and Tesla, have already gotten beat up pretty good. And so there's a value play to be made, oversold, positive divergence. And so again, that could also be an indirect hedge, even though it's part of QQQ and part of NQ. But they should outperform. And by outperform, that means one of two things. When a stock outperforms an index, people think of, okay, the NASDAQ goes up 10%, the stock goes up 20, it outperformed. There's also outperformance to the downside, meaning I suspect QQQ is going to drop quite a bit, and then Apple and Tesla will probably fall less. That's outperformance as well. They just dropped less. We're 37 minutes into the video, and I was going to chop it there, but I'll just rifle through these. These are the semiconductor equipment maker stocks, since I mentioned it, and I do have some, I do want to step out of my office before the close today and get one errand knocked off that I need to do. So I'm just going to go over the charts. I'm just going to summarize real quickly what I see on. And I'm going in order of market cap, by the way. So keep in mind that the ones that I'm starting with have a higher weighting and more importance in the sector. ASML, and I'm assuming I'm just going off how the list populates on TC2000. I'm assuming every company I'm covering is a chip equipment maker. There's a bearish rising wedge right there. Give me my line tool. Rising wedge, divergent high, breakdown, and it's been stair-stepping lower. Back testing, this was a support level 929. It's at resistance now, and if it goes any higher, there's a downtrend line there. So there's a stock to me that looks like it topped, and it's in a downtrend solidly, and like many others, broke a recent trading range. AMAT, Applied Materials, coming off a big divergent high, impulsive move so far, a little kickback rally. It pierced I have my important level at 196.45, but I can see a sub level here. It is certainly resistance right there, reactions along there, about 205. And again, coming off this big divergent high, and I'm still targeting this trend line. It looks to be possibly flagging. The flag's getting a little long in the tooth, but one to watch. Lam Research, divergent high, wedge break, secondary trendline break, stair-stepping lower again. So you're seeing a common theme in not all of these. I wouldn't be doing the video if they all look the same. There's KLAC, and that one's trying to pop this downtrend line today, but also coming off a divergent high right here, negative divergence, followed by a trendline break, that yellow line, which was my important level, with a big red candle. Then it went on to break that support. Now the fact that it's regained this support, does call it into question. Ideally you would want to see it rejected there, and now especially at that downtrend line. So kind of a mixed bag, but again, they're still well off these divergent highs and below the trend line breaks, which put these guys, most of these, on sell signals. Some look better than others. This one, same thing. So you can see these charts look identical, but I'm going to get down to some of the smaller ones. I'm going to give you some trade ideas on the long side. If you are interested in this sector or just individual plays, divergent high moving lower, divergent high moving lower. See, same story on a lot of these. And again, birds of a feather flock together, guys. It's kind of like going over GDX. You'll notice when I go through the components of GDX, most of the charts look identical. They ebb and flow with the price of gold, and all the miners tend to move together. Most of them, not all of them. There's sometimes. So here's one, IPGP. Yeah, big divergent low, a downtrend line, resistance level at 9160. I think I have a price alert set there. So if this sector holds up, this guy looks good as a, and it's also near that previous, it's actually long-term support down there. So there's one for you, for your bulls. But remember, birds of a feather, guys. So maybe this is just what happens in a bear market. And this stock peaked way back here in 2021, clearly in a bear market. You get these little bullish setups, and they're usually good to trade, but they're good to trade for a a bear market rally. That was a divergent low, by the way. I don't have them all marked up here. Bear market rally, another wedge, divergent low, bear market rally, but it ended with a divergent high, divergent low, bear market rally. So again, we can trade bear market rallies, but ultimately that's what this thing is in right now. However, like I said, one of the better looking ones in my opinion. CAMT, divergent high, breakdown, back test in this trading range. So, I'm watching these guys, this sector collectively. If these break down, then that's a bad ominous sign for the semiconductor sector, which in turn is an ominous sign for the tech sector, which in turn is an ominous sign for the stock market, okay? ACLS, look at that beautiful bullish falling wedge. So there's one for you. Only thing I'd like better if it was at support, but you don't always get that. So, you can take a break of the trend line, especially, those that are bullish and looking for new highs. This chart offer much better RR than, even NVIDIA right now. Things like that if you're bullish. KLIC, another one, divergence, little downtrend line, which trigger a pop. This one just came off a divergent high. Looks like the rest, negative divergence, breakdown, back test right now, objective short entry. DQ, this one has a nice, it back tested this long-term downtrend line lately. This is another stock clearly in a bear market, like so many. But there's a downtrend line and what looks like an inverse head and shoulders pattern. So if in the next week or so, I close out my index shorts in semi-shorts and I decide to go long, these are some of the longs I'm going to be looking at right here. These are some of the ones I think have more potential than some of the others. Or at least they're my kind of charts. Some bulls like to trade continuation patterns, like to keep buying something that's going up. And that works until it doesn't. It's like a game of, it's a hot potato or musical chairs, whichever one you want to use. Breakdown, coming off a divergent high. I didn't mark it all up, back test. See, most of these are just coming off these divergent highs and just recently breaking down support. There's another one. I'm not going to go through many more because what I'm doing is I'm getting down to these smaller companies. This is a $1.7 billion company now, so it's not going to move the needle as much, but it's just kind of giving you some insight and visibility into the sector and showing you a lot of these, are set up for at least bear market rallies. So again, if next week, bam, QQQ 433 is recovered, NVIDIA rips above, where it is now, takes out the trend line, they start buying back up Meta or whatever else that's gone down lately, and Apple starts to rally, and the market looks like it's going to have some legs and maybe punch through a new high, then these are some of the ones that I'll be looking at. And I've got some others out there. I think I shared MKTX. It's not a chip equipment maker, but it's at support, positive divergence. And they're into bond trading, and bonds have been going down. So they say, I've read that most other countries have stopped buying our bonds, or at least to the extent they used to. But it's a lot of retail traders. But if ever retail traders and institutional traders start jumping on TLT and all that again, then maybe gives these guys a little boost in profits there. All right. You have the levels to watch. I'm going to wrap up by showing you Mr. VIX is holding. That's not the VIX. Mr. VIX is a little bit below that 1573 level. It's really not responding much today. Down a fraction of a percent right now and still well above this uptrend line. So I'll end it here. The things I'd be looking for, our NVIDIA falling back down, failing, especially if it can fail to solidly close above 840 today. Of course, want QQQ to remain below 433. To see a late day dump too and erase some, even better, all of the gains in the NASDAQ would get this divergence confirmed that I'm looking at there. NQ, you've got that divergence right here, beautiful 60-minute divergence on NQ. And if this happens, which is what I'm leaning towards, it's a, very contrary call with everybody, animal spirits again, everybody giddy over Alphabet and Microsoft earnings. If that happens, it's going to be very bearish because it's going to wipe out probably all of Microsoft's post-earnings gains, maybe even get that sell signal on Microsoft, and then that's another one to buckle. And then you'll start to see the gap get backfilled, most likely on Alphabet, today's gap, that is. Okay, I will stop it here. It's 45 minutes into the video, covered the equity markets, a couple trade ideas, like I said, the metals and miners and wheat and treasury bonds, and those are kind of the core stuff, and the VIX that I'm looking at trading now, and small caps too. Small caps are up today just because it's a risk-on trade, but they're still said I'd stop, but I should cover that. They're still well down from their divergent high right here, and then the wedge breakdown and back test, and then moving lower. And also today we're at, I should mention, downtrend line resistance right there. If it can eke up, I'll get a little bit higher. We're going to get 6 divergence here on the 60-minute chart. Remember, we posted covering shorts at QQQ when T2 was hit on earlier this week and at the end of Friday. And this too, because we had this bullish falling wedge, which I showed you, has played out, rallied right into resistance. And so we could pop one more thrust up and it would give us a nice divergent high. Not a necessity, believe me, being short the small caps, I'd rather see it fail right here. But I would welcome any divergent high, just like I said this morning on QQQ, which we've since gotten. But other than that, this is what the daily looks like, and nothing. This was one of the big levels, 199.70, big support level, former support level, now resistance, and still looks good. In fact, if anything, could be flagging here with a flagpole, bear flag, and maybe we get this in the next week or so. All right, I will wrap it here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.